Okay, so good morning, everyone. Hope everyone's well. This is the macro snapshot. It's Friday, January the 9th, 2026. Recording this quite early in the morning, about 6:45. Okay, guys, so we've got a couple of quite big decisions coming up today, or when I say decisions, potentially we have the Supreme Court of the United States, SCOTUS, which may or may not, but it looks as though it will be issuing some kind of opinions on the legality or the non-legality of Trump's tariffs. So I'll talk about that in a little bit. That could have major market implications, especially potentially for the bond market. But obviously, we also have the non-farm payrolls coming up at 8:30. We also have Canadian data at 8:30, but the non-farm payrolls, that's for the December period, and that's one of the first sort of real data points about the labor market we've had since the shutdown of the government over the last 2 or 3 months. It's been very choppy data. So the market's looking forward to getting a read on the labor market and the employment situation in the US. So first of all, let's just see what's going on with the Fed. A quick recap for the January meeting, which is in about 20 days or so. You can see here that essentially at the moment, the target rate is between 350 and 375 basis points. At the moment, as you can see, according to the futures market, about 86% of market participants are expecting no change at all. And that's just because, the economy seems to be relatively robust and the employment situation seems to be relatively robust. But keep in mind that what Powell said, that they're very focused. The Fed is, relatively happy with the inflation situation. So the focus in terms of the two mandates has gone back to the employment situation. And Powell is concerned that that could be cooling a little bit and weakening. But basically, we have to keep in mind a couple of big things here that because of Trump's very, very strong sort of anti-immigration policy, there's less immigrants coming in, undocumented, documented, and that means the pool of available workers is shrinking. And therefore, typically over the last, sort of 5, 10, 15 years, the replacement number of necessary jobs for the US economy was around about 150,000 or so. But now it seems to be, maybe even half of that, 60, 70,000 jobs a month is sort of an equilibrium point. And that's what Powell has signaled that the U.S. economy doesn't actually need to be creating as many jobs as, let's say, sort of 12 or 24 months ago. Powell also considers that because of statistical problems, the number of jobs being created in terms of the actual numbers reported are maybe over-reporting a little bit optimistic. And even he gave some kind of algorithm at his last FOMC meeting, basically saying that you maybe need to subtract about 60,000 jobs from the headline number. So the point is that the Fed and Powell are a little bit worried about the employment situation. So. But having said that, the employment situation does seem to be relatively strong, and that's why the market is only ascribing here. You see about a 13.8% chance of a cut in January. Now, today, if we get an incredibly low number, this obviously will change a little bit, but it would require, I think, a fairly low number to sort of cause the Fed to think about cutting again, especially with relatively sticky inflation still and an economy which does seem to be fairly robust. So if we actually just have a look, let's just have a look and see a couple of things here, see what's sort of expected. So I just got a couple of little numbers here. So I just pulled out a screenshot from the Bloomberg, actually from yesterday. Just of what's sort of expected. So before we actually just look at that, let's just quickly review the employment data over the last week or so, just to get a bit of context. So first of all, for the ISM numbers, which are not being super correlated to the hard data, they're surveys, but the ISM sort of manufacturing was relatively weak, but it's been on the weakish side for a while. But maybe even more importantly, the ISM services, that was actually fairly positive. We got that a few days ago. New orders were positive. Prices paid was coming down, and the employment situation actually went up. So the employment in terms of the services, ISM services, was quite good. The ADP number we had was about plus 35,000. That was okay for the private numbers. The JOLTS number, which we had recently, was weak in the sense that it looks as though employers are not really sort of hiring a lot, but they're not firing a lot. The quits rate was up a little bit, but the number of posted jobs was down. So that was a bit of a mixed number. You could say maybe slightly weak. But what has remained very strong and is a real number is the initial jobless claims. Basically, we got that number. I think it was yesterday, and that's a very low number. It's about the 4 week average is about 210,000, and that's indicating a labor market which is absolutely not in recession, and if anything, is still quite resilient. So the point is that the Fed at this point will need something very dramatic in a negative sense to change that pricing for January. So let's just see what the market is expecting. The average estimate here, the median is about 70,000. Now, in terms of the dispersion, there is a relatively wide dispersion, at least in terms of the Bloomberg survey here, about 60 odd economists. The high expectation is for 155,000, and some of these higher expectations are coming in basically on the fact that the economy seems to be doing okay, the real economy seems to be doing quite well, and as I just mentioned, initial jobless claims are actually very low. So there's no need to panic. So, but maybe 155 is on the high side. On the low side, you've got 23,000 jobs. So nothing negative. So you got a dispersion there of about, what's that, about 130,000. As I say, the average, the median, but let's call it about 70,000. Now, what's always important in terms of trading and markets is also the standard deviation. You can see here in terms of the Bloomberg survey, the standard deviation is about 25,000. So anything above, what's that, about 95,000 would be one standard deviation. And really anything, between one and two standard deviations will start to get the market's attention. On the other side, on the other hand, on the downside, anything below, let's say about 45,000, 50,000, or 45,000 and below would be one standard deviation. And then going down to 20,000 would be two standard deviations. Which is, about, of course, about 95% of probability in terms of algos and whatnot. So let's keep an eye on those numbers there. And just finally, in terms of the big picture, let's just have a quick look and see what's going on in the SOFR curve. I've got this is about from a day ago. This is in white where we are. And this is just comparing it, let's say, going back to about mid-October. So the middle of October, so a couple of months ago. And you can just see the change here that the market overall has repriced in a hawkish way. So you can see here on the right hand side is the implied interest rate. So you can see here that the trough rate or the low is around about 3.15%. Now, of course, Trump is way lower. Keep in mind that people like Trump and Stephen Moran, they're talking about cutting 125 or 150 basis points this year. So they want this, down to be, actually be off this chart, down about, 2% or 1.5%. So just keep in mind just how far away from market pricing what Trump desires. But nonetheless, so the market is still pricing in, a couple of cuts, two and a half cuts for in this sort of cycle. And thereafter, you're getting down towards the end of 2026. And then, of course, pricing in hikes going into, 2027, 2028. But that's for the long term. But basically, the market, as I said here, has repriced slightly hawkishly expectations for the Fed. And that's, as I say, on the back of, relatively strong economy. So that's what the consensus is. Now, in terms of whether this is going to be market moving, let's just have a look and see a little bit. What I want to just show you, the implied vol is actually quite low at the moment. So if we look at what the market is pricing, and I'm going to take the 0 DTE, so just the 1 day DTE for the ES, the futures, so the S&P 500 futures contract. And you can see here, as we say in real time, about 7 o'clock this morning, we're pricing in about, technically 42 points for the straddle. So, 24 for at the money call. You see here, there's 54 delta on the call at 24 points and 45 delta for the actually I might just put it up here. That's moved a little bit here, so we're going to go for that one 29 and that one there. So the 69.65 I'm going to get rid of, and hold on, let me just keep that. So yeah, so just the pricing gone, yeah, pretty much the same though, about 42 points. So 42 points, about 160 ticks, or if you want to put that in percentage terms, that's about 61 basis points. So the market is pricing it today with the potential for a Supreme Court decision. A straddle break even will be, as I say, 42 points or 160 ticks, or about a 0.61% move, which I personally find to be relatively low. I think that's relatively conservative, to be absolutely honest. And I think that that's an interesting one there because if we do get a strong number and we get a sort of an interesting sort of decision from the Supreme Court, I think, it could be that the equities move out of that. But anyway, that's what the market is pricing. And if you actually have a look here, that's just because the implied volatility regime, if you look here, you can see here on the ES, the 52-week implied vol percentile. It's only 8 in the eighth percentile, so very, very low implied vol. And in terms of the ranking, only 19 out of 100, so still pretty low. And again, if you look at the SPY, similar kind of thing here, pretty low. So the point I'm trying to make here is that the implied vol regime is quite low. So anyone who wants to be long Vega or long volatility, that's maybe an interesting play. Now, just in terms of how the market could move, what does the market want? I think pretty clearly what the market wants. Oops, sorry. Just let me go back to something. I'm going to just bring up, what the JP Morgan team is. Hold on, guys. I just have to find something here. Let me just focus here. Got a lot of things. Yeah, this is the one. So yeah. So just in terms of what's the sweet spot, basically what the market wants is a number which is not going to be too hot, too high, indicating an economy which is so strong that there could be inflationary problems, and the Fed really might have to sort of stop even thinking about cutting anymore in 2026. On the other hand, the market doesn't want anything which would indicate an economy which is completely collapsing. So let's just look at the sweet spot here. So the sweet spot here, and again, this is just sort of coming from the JP Morgan sort of analysis, is something between 35 and 75,000. We saw the consensus is around about 65, 70,000 or so. So according to JP Morgan, and I think that's reasonable. The sweet spot is an economy which is doing okay, is a labor market which is doing okay. And so you see here that, they're indicating that the probability of about 40% is, for, a relatively sort of, about 25, 75 basis point gain in the SPX, just for that sort of Goldilocks in the middle. As you can see here, if it gets a bit stronger, that's maybe not too bad, but anything too strong, let's say 105, over 105,000, they're saying that would actually cause the market to go down. So you see here, anything too strong, you see the probability distribution here. Anything over 105,000 is no good. On the other hand, anything negative obviously is a negative, but again, low probability for those outliers. And if it's on the weak side, let's say between 0 and 35,000, it could just sort of oscillate a little bit. It's difficult to know that one there. It could just be a small sell-off. And again, really what the Fed is probably most focused on at the moment, we'll just look at some of the numbers, is going to be the unemployment rate. It's not even so much the headline number. It's really the unemployment rate. That's probably the one which is going to get the most attention. And you can see here that consensus for the unemployment rate is to actually head down here. So it was previous 4.6, and now it's the consensus is to go down to 4.5 or so. So that's really probably what the market is going to sort of focus the most on, because that's probably what the Fed is really the most focused on. So keep an eye on that. Just while we're on this page as well, we also have a Canadian employment here. Now the consensus here is for sort of a slightly negative number, around about just minus a few thousand, minus 5,000, minus 2,000, something like that, and the unemployment rate to actually go up a little bit here. So you can see here that the consensus here is for the unemployment rate is to actually rise in Canada from 6.5 to 6.6. Now, that wouldn't be great for the Canadian dollar. Does that mean that the Bank of Canada will hike? I don't think so. Keep in mind that recently as well, we've seen that because of the situation in Venezuela with the oil, Canadian oil, which is kind of in competition, it's a very heavy and sour oil grade, very similar to sort of Venezuela. So the idea here is that if the Venezuelan oil is coming more into the Gulf refineries in the US, that could put a bit more competition and downward pressure on the Canadian brand of oil, the Canadian like a Cold Lake or the West Canada Select. And in fact, if we look at the spread between WTI and a Cold Lake or a West Canada Select, that's gone down to about $15. Actually, it's expanded to about $15, the discount. So this is not good for Canada and the balance of trade, a balance of payments for Canada. And that's put a lot of pressure on the USD CAD. The USD CAD has gone up over the last couple of days. So the point here today is that if we have a weak employment situation, plus potentially some problems with Canada's oil exports, prices going down, that's not going to be good for CAD. So anything weak here, combined with a relatively strong US number, will be a definite negative for the Canadian dollar today versus the US dollar. Other numbers to be looking at here, of course, is the in the US, just getting back to the US here, as we've already gone through the main numbers, but so keep an eye on the unemployment rate. That's really going to be the key number. Average hourly earnings, in the old days, well, before, previous was 0.1. So again, not super inflationary. If that goes up, does that indicate a bit of sticky inflation? Sure. So if we get average hourly earnings, which are sort of are strong, combined with sort of a lower unemployment rate and a high headline number, for sure that a 14% possibility of a cut in January by the Fed will probably be taken off the table or quite dramatically reduced. So, basically no chance of the Fed cutting in January. On the other hand, of course, if all these numbers are negative, so we get unemployment rate going up to 4.7, 4.8, a negative payroll number and average hourly earnings going down, for sure the front end of the curve can rally. Okay. So that's that, guys. So much for the non-farm payrolls number there. But the market today will also be looking a lot at the bond market, particularly. But we'll get onto that. If we look at the situation here, just have a look at a few charts here for the Supreme Court. So we all know that Trump has put a lot of tariffs on. That's under the IEEPA, as kind of the Emergency Act. And the whole point today is, will the Supreme Court of the US say that that was actually illegal and unjustified? Now, I would say there's probably been a lot of communication between the White House, the US government, and the Supreme Court behind the scenes. Probably what's going to happen is some kind of compromise. Now, if the Supreme Court comes out and says, hey, Trump, hey, White House, actually, this is not really an emergency situation. You're going to have to use one of the other sort of, sections, talking about Section 232, Section 301, 338, 122. The point is that in the US, there are a lot of potential sort of technical ways that the US government can impose sanctions, not invoking the Emergency Powers Act, but more technical kind of stuff, shuffling around the paperwork. Of course, the cleanest way to do it would actually be to go to Congress and get congressional approval, but it looks as though Trump doesn't want to do that. So the point I just want to make is that even if the Supreme Court today, and it's potentially coming out mid-morning, says, hey, under the Emergency Act, it's illegal and money has to be paid back, or it needs to be using a different statute. That's the most probable thing. What would be, first of all, an extreme case? An extreme a slightly unexpected outcome. Excuse me, I've run out of tea here. Would be, let's say, if they say it's completely legal. So the first scenario would be the Supreme Court says, no problems, Mr. Trump. You used the Emergency Act and imposed tariffs using that as a justification. No problem. We fully agree to you. That would be a positive, first of all, for the bond market. So what I want to do here is just look at bonds. And I particularly want to concentrate on the long end. And we need to be framing this is the ZB. We need to be framing this conversation in the following way. Tariffs have been a little bit of a negative for the consumer, maybe for some importers, and for different kind of companies who have had to eat the tariffs. But one could argue that, let's say, for example, in the stock price and pricing, that has slowly been absorbed into the whole sort of import-export chain into the US and consumption chain. The issue is that definitely the deficit is actually going down because the revenue from tariffs has been significant enough to enable the US government, it's been significant enough to make a bit of a dent in the US deficit. And of course, there's a lot of concerns that the US deficit is too high, it's structurally too high, and that the US government, or the Treasury rather, has to be issuing too many long-term bonds to fund all the programs of the government with these very high deficits. And the tariffs, like them or hate them, have contributed in a positive way. There's more money coming into the US, and that's enabled the US deficit to come down. It's marginal, but it is sort of coming down a little bit. Now, the problem here is that if the let's not the problem. If the Supreme Court today rules that the tariffs as they stand are legal, that would be a positive for the long end bonds. Why is that? Because it means that the tariff revenue will continue to be collected, and that means, all things being equal, that the US Treasury will not have to issue an unexpected extra amount of bonds, which would be negative. So that would be a positive. I do believe in that situation there, we could see a pretty, a nice rally in the in the US bonds, the long end bonds. That should flatten the curve. And we could even get, if we just look at, let's say, US yields, if we look at, let's say, the 30-year yield, that could rally down to, maybe something down here, maybe like 4.75, 4.77, something like that. I think that would be a positive. So yields down and the US 30-year up, and that would probably also be a bit of, quite a positive as well for the for stocks in a sense as well, because that would, yeah. So, well, we'll get to that in a second. Okay, so that would be the most probable thing. On the other hand, if we get an illegal ruling. What does that mean? The Supreme Court comes out and says, hey, in its current form, this is not good. Either you're going to have to go to Congress for authorization, or you're going to have to use one of these other statutes. Now, can the White House do that? Most probably. So what I'm trying to say is that it's not as though tariffs are going to disappear, even with an illegal ruling. But that would, excuse me, certainly complicate things for a little bit. And there'd have to be a lot of sort of paperwork done and all kinds of legal maneuvering. But let's have a look. Let's say they say that it's illegal. First of all, for the bonds, this would be a problem, as I just said, because essentially, we're talking about repayments and all that kind of stuff. But just in terms of the bond market, that would definitely cause a sell-off, probably a steepening of the curve. So a bear steepener, the long end yields would go up more than the front end yields. The idea here would be that the US Treasury would have to probably be issuing more bonds, long-term bonds, because the deficit would be rising. And that would be definitely a negative for the long end of the bond. So if that would be happening by long put spreads on ZB or ZN, or just sell the ZB. Now, the other problem there is that if you also have to be looking at equities, because if the long-term yields go up too dramatically, that would not be good, especially for something like the tech companies, which are very sensitive to long duration. So something like NASDAQ would possibly sell off at some point. Now, on the other hand, you know, what happens if we get this illegal sort of reading? How does that sort of work out for stocks? So you could argue that in the short term, the knee-jerk reaction could actually be positive for stocks, because you could say it's like less pain for consumers with less import duties and tariffs. There could be potential reimbursements, because a lot of companies have already paid billions of dollars, have already been paid for tariffs. So there could be potential reimbursements. Although I was doing some research yesterday, that's going to be a long and complex process, and it's not as though companies will suddenly overnight be reimbursed for those tariffs. And also, of course, profit margins may actually go up a little bit, because they're not having to eat some of those tariffs. And so I was reading some research yesterday which said that on average, if the tariffs were to sort of disappear or be substantially reduced, on average that could be about a 2.6% extra earnings for many companies. I mean, these numbers are kind of complex, but on average, for companies that would be a good thing. And one could argue for the consumer, there's a few more dollars left in people's pockets if they're not paying the tariffs. But will companies roll back the tariff? There's a lot of complexity there. Now, who would actually benefit? I think what could be quite interesting is, something like consumer staples. You've got things like sort of Costco. They've had to have the tariffs. And if we actually go and look at some of I just want to go into the equities here. Let's look at the sectors. Very interesting yesterday, if you actually look at something like consumer staples, which is it this one here? Yeah, consumer staples. A giant candle yesterday, and it's very interesting. And I think this is on the consumer staples, just in the idea that companies like Costco, who have to have put on a lot of tariffs. If the tariffs are ruled illegal, suddenly that would be a positive for a lot of these consumer staple companies. I think of your Costco's and the Walmarts of the world, but it may even be a bit too late, because you saw a giant green candle yesterday. Industrials could do pretty well. Consumer discretionary, at a certain sense, also could do quite well. Again, green candle yesterday in consumer discretionary. And think in terms of like clothing companies, toy companies. So you think in terms of companies like Nike or Mattel for toys, or Wayfair, like the furniture importers, or Restoration Hardware, RH, or Williams Sonoma. So a lot of these sort of consumer discretionary companies, furniture, goods, all this kind of stuff. If the tariffs are ruled illegal, that's definitely going to be sort of a sector which is going going to do quite well, I'd say. So again, Wayfair, RH, Sonoma, Williams Sonoma, Mattel for toy makers, Nike, these kind of companies is quite a good one. So that's something to think about there. As I say, we may not get that, but the rumors are saying that the Supreme Court will actually sort of be giving some opinions or even a final ruling today. So let's keep an eye on that. Now, of course, keep in mind that we should actually look at all of that in the context of what happens with the non-farm payrolls. Those of you trading Canadian dollar as well, keep that all in mind. One thing I just want to have a quick look at here is just keep an eye on the oil situation here. I posted yesterday, just keep in mind that we've got the oil went up. They had quite a strong day yesterday. Now that's also because the commodities index, the Bloomberg Commodities Index, there's a lot of mechanical buying of oil going on over. It's probably started yesterday over the next few days. Now obviously the algo is going to try and make that as non-market moving as possible, but maybe that's a little bit of mechanical buying. We also have increasing concern about potential regime change. Well, at least I mean, that's a long way away, potentially in Iran. But the point is that people are getting nervous, a lot of street protests in Iran. Is it possible that the Iranian government, the Iranian regime, is potentially going to fall? If that's the case, there could be some disruptions to oil. And I think that combined with the bounce, it gave a little bit of a push up in oil yesterday. Now, the other issue as well is that in terms of Venezuela, a lot of the big oil company executives are meeting at the White House today with Trump. And of course, Trump is saying, yes, we're going to push, and oil is going to start pumping from Venezuela. I think that's priced in just at the moment. We'll see. I mean, that could prevent a huge, that could be a cap to the upward prices, but I think that's sort of priced in at the moment. And the reality is that any significant output is going to be taking at least 6, 12, 18, 36 months, to have a significant sort of change, in my humble opinion. So I think oil could be range bound here, but I think just to say nerves about the Iranian situation is pushing oil up. But what we do have here, you can see, is that we're at the 50-day moving average here, so which is still moving downwards. This is just a little bit of overhead resistance there. And if you just want to look at a fib, you can also see here that this also coincides here with the 61.8 fib retrace from this sort of down impulse from the 5th of December. So a little bit of resistance happening there. We'll see what happens with oil. You've got to keep your eyes on headlines. If the Iranian situation deteriorates, who knows, over the weekend, maybe oil can push higher. We'll also see what the oil executive have to say today at the White House. If they say, yes, we want to go in aggressively, spend hundreds of billions of dollars to try and ramp up oil production as quickly as possible, of course, that could put some downward pressure on oil as well. We shall see what happens there. In terms of other markets, well, we spoke, you will see what happens with the equities. I think I might just leave it there, guys, just for the moment. And let's just see what shakes out at 8:30 and later today with the Supreme Court decision, if indeed it does come. Thanks very much. Have a great day. Have a great weekend. And we'll be back next week with the macro snapshot. Thanks very much. Goodbye.